spent weeks refining a strategy. The RSI aligns, the support levels hold, and you finally hit buy on URUSD. But once you click that button, your trade has to go somewhere. The question is, where? This diagram illustrates a single buy order branching into different paths. Most traders spend years obsessing over their charts, completely blind to which of these execution pathways they are actually trading against. Dropping a perfectly good strategy into the wrong execution environment creates a massive, invisible tax on your capital. To protect your edge, you have to look under the hood and understand the precise mechanics of dealing desks, STPs, and ECNs. First, we have to establish a hard rule of the Forex market. There are no free trades. Every broker has to get paid. The most common way they do this is through the spread, charging you a slight markup on the actual market price of an asset. The alternative is paying a fixed upfront commission on every trade in exchange for raw, unmarked up market access. A fee structure that supports one strategy can create a significant mathematical drag on another, potentially erasing your edge over time. Choose a broker by auditing your specific trade frequency and position size to identify the exact fee model that protects your bottom line. The starting point for most retail accounts is the dealing desk, commonly known as a market maker. Market makers act as the house, selling to you from internal inventory. They take the opposite side of your trade, generating revenue by quoting a spread wider than the true market rate, like quoting 1.2649 by 1.2652 when the real price is 1.2650 by 1.2651. That extra pip of difference is their profit margin, which means your trade starts off in an immediate negative balance the second you execute. Because the broker holds the other side of your position, a persistent myth claims they will actively hunt your stop losses to take your money. In reality, heavily regulated modern brokers want you to survive. They would much rather collect the spread on thousands of your trades over a lifetime than wipe you out in a week. Market makers provide essential market stability and allow you to start with very small deposits. But that convenience comes with a continuous tax applied to every single entry and exit. If you prefer not to trade against the house, you move to the no dealing desk model, starting with straight-through processing, or STP. In this routing model, you can see how an STP broker acts as a literal bridge. When you hit buy, your order bypasses the broker's internal systems entirely and is routed directly into a pool of Tier 1 banks. To make their money, the STP broker looks at the best bid and ask prices provided by those external banks and adds a tiny fractional markup before showing it to you. Because banks compete to fill orders, you gain access to highly competitive variable spreads, especially during peak overlap hours in London and New York. The catch is that those same variable spreads can widen drastically and unpredictably the moment a major news event hits the wire. STP routing removes the broker as your direct opponent, giving you peace of mind, but it transfers your execution risk over to raw market volatility. For professional and high-frequency traders, the Electronic Communication Network, or ECN, is the absolute gold standard for market access. This centralized network model shows an ECN environment. It's a digital hub where retail traders, massive hedge funds, and global banks all intersect and trade directly against one another without a middleman. This environment provides complete transparency, allowing you to see the exact depth of volume available at different price levels before you execute. The pricing model is entirely different here. You get 0 pip raw market spreads, but in exchange, you pay a fixed dollar commission on every trade. Look at this comparison table. Trading one standard lot with a market maker offering a 1.5 pip spread costs $15. On an ECN with a 0 pip spread and a $7 commission, your total cost is just $8. If you are an active trader moving high volume, that $7 difference per lot compounds rapidly in your favor. Keep in mind that many modern major brokers operate on a hybrid model, automatically routing your small micro lots internally while sending your larger positions out to the ECN. True ECNs deliver unmanipulated market access and mathematically superior scaling costs, provided your account actually moves enough volume to justify it. This decision matrix maps fee structures against trading styles. The right choice comes down to matching your daily trade frequency to the optimal broker type. Take the scalper. This trader executes dozens of positions a day, targeting tiny 5 to 10 pip profit margins. For a scalper, paying a 2-pip spread is an instant 20 to 40% tax on their target. They have to use an ECN to access those raw 0-pip spreads. Then there's the swing trader. They enter a few positions a week, aiming for massive multi-day trends. A slightly wider spread won't impact a 100-pip target. They benefit most from the reliability and variable pricing of an STP or hybrid model. Finally, we have the beginner, or the trader running a micro account with highly constrained capital. A fixed $7 commission would completely devastate the math on a 10-cent micro lot. They require a market maker to absorb those small sizes and keep entry costs proportional. By identifying exactly how you trade, you stop paying for premium execution you don't need, and you stop losing capital to hidden spreads your strategy can't survive. There is one final non-negotiable metric that overrides all of this: Tier 1 regulation. A heavily regulated market maker will always be safer than an unregulated offshore operation, claiming to offer you true ECN pricing. This quadrant chart plots execution transparency against regulatory oversight, and the top right corner is where you want to be. Tier 1 regulators force brokers to keep your capital in segregated accounts, ensuring they can't use your deposits to pay their own expenses. Your next step is practical. Open up your trading logs. Calculate exactly how much capital you bled to spread markups over the last month. Run those numbers again and compare what you actually paid in spread against what you would have paid in fixed ECN commissions. Precise entries generate your theoretical profit. Managing your execution costs determines how much of that profit remains in